So I had somebody ask me to explain the concept of raising inflation lowers the real interest rates, makes the economy less restricted, and is a benefit to the top 10, 20% of household incomes. Now, this is a very confusing topic to try and explain, but I think I come up with a good way of understanding it so that you can then internalize this for a better understanding of how it is that you position yourself to then be part of the economy and how it is that you can actually benefit from it. So now understanding that when inflation rate, when you raise the inflation or when inflation is increased or you have elevated inflation, that lowers the real interest rates. And this blows people's mind. They can't figure out how that works. So now if I give you an idea of a return on an investment, this is going to make it a lot more sense. So you're an investor who is going to lend out money, right? And if you lend out this money, you're going to get a return. So let's assume for just a second that you are going to lend out some money at 5% interest, man. Now, if you have zero inflation, you're going to get a 5% yield. You're going to get a 5% return on your $100 investment or whatever it is that you got going on, the $100,000 investment, doesn't matter what it is, it's all a percentage. But you're going to get a 5% return. If you have an inflationary scenario that is at 3%, then what the investor is going to get is a 2% return. So if you raise the inflation, you lower the real interest rate, the rate that the investor is going to receive from the investment that they have put their money towards after the inflationary scenario has taken place. So we can understand that if you are a lender, if you are putting money out there to try and get a return and you have an inflationary scenario that is elevated, it diminishes your returns. If you have elevated inflation that continues to run rampant, you're stuck at 5%, but inflation goes up to 5%, your return is zero. You get 0% return on your investment. If inflation continues to elevate and you go up above the 5%, and now you got inflation at 6, 7%, now you have a negative real return. You have put money out there with a 5% return, but because inflation is running at 7%, you are now receiving a negative return. You are losing purchasing power on your investment. So now, as again, if you think about this as the investor point of view, like I'm going to put money out there to try and get a return. If we have inflation running high, my return diminishes, right? It gets less. If inflation drops, my return goes up, right? I get a higher return for the inflationary scenario that is diminished. Right? So now we can see it in this fashion as an investor or as somebody who is lending money, how inflation can be a very damaging thing as we are expecting a return on that investment that is now becoming less over time as it's getting eaten up by the inflationary scenario. Totally makes sense there, right? So now if we can understand it from a lender point of view, you can understand it from the borrowing point of view. That if you have an inflationary scenario that is running rampant, this is a benefit to you because it lowers the real interest rate, right, that you're essentially paying. And now I know this is very difficult for a lot of individuals to try and internalize, but once you see this, it's going to start making a lot more sense on why it is that the people who are closest to the new money, which is debt issuance, are doing so much better in an elevated inflation environment because the real interest rate is much less. It hurts the people who have lent money and it benefits the people who borrow money. So now think about it again. If you are closest to the new money, you are borrowing money to acquire a mortgage to buy the asset that then has a yield to it, you are going to do quite well in an elevated inflationary environment. It actually benefits you. It's a feature to you because you are borrowing that money and you have the elevated inflation. It lowers the real interest rate that you are paying. Total win. Exact opposite works for the person who has lent the money out there, is that they are put the money out there at a 5%, expecting a 5% return, but if inflation raises to 3%, their real return is only 2%. It damages them and benefits the borrower. So again, if you can understand that the economic force that is playing out here, see, this is the thing. The reason why real estate works so well to try and get into a freedom kind of lifestyle, being independent of all the, working individuals out there, it works because you are borrowing money. But not everything can you borrow. Like, you're not going to be able to borrow money as cheaply as you can in the mortgage market because of the underlying asset that you are using the money to buy. Because you are buying a house with it or some sort of property, the availability of the loan and the interest rate that you pay is much less because there is an underlying asset that you are borrowing against. That gives you a much cheaper interest rate so that then you can go and buy the asset that then has the renter paying a higher yield. So you get that little spread in between, essentially. Borrow cheap, right? Put it into something that pays a higher yield. That's the economic force. It's not complicated. The hard part is like there's not a lot of places out there that you can borrow money as cheaply as you can in the mortgage market. All right? See the whole thing works exactly the same way. It doesn't matter what it is. It doesn't have to be a house and rental. If you can just understand the underlying economic force says this: if you can borrow cheap money and then place it in a high yield return, that is it. That is it. That's exactly what all the investors are doing with mortgages and rentals and property. They are borrowing cheap and putting it into something that is going to pay a higher yield. And they get the little bit in between that. They fix the property up, increase the value of the asset itself. There's some money that can be made inside of that. Right? So there's places that the real estate market can benefit in many different ways, but the underlying understanding of the economic force is borrowing cheap and getting a higher yield from it. So if you can borrow cheap money, like wherever you got an uncle who's really, really rich and just loves just lending money out to his family for no interest, that's pretty cool, right? So if you can borrow money really cheap and then deploy that money into a high yield, whatever that is, you got a business out there that you know the guy is going to run really well and he needs money to operate his business, you can lend it to him and he's going to pay you a higher yield than what it is that you're borrowing from, right? So if you can figure that out as the middleman, where can I borrow cheap money and where can I deploy it to get a high yield? Real estate is the easiest way to do that because it's built into it. Like the mortgage is already cheap. Cheap interest rates, cheap money, right? The yield is already there within the rental income, right? So you know that that's the place that you can put it. It is very isolated to that, even though it's huge, right? I mean, it's huge. Lots of money, lots of places, lots of things to go to, but it's isolated just within the real estate game. That's where the cheap lending is. And if you want cheap money, how do you do it? Well, you got to borrow for a mortgage. That's where the cheap money is. People or lenders are willing to deploy money into that for a lesser return, for a lower yield. So that's the place that you can get cheap money from, is in the mortgage market. Where do you get a high yield, right? You get it from rental incomes. If you find a place that you can buy that has a high yield in rent, right? People are paying a decent amount for it. Understanding that's as simple as it gets. That is just the basis of everything. And it doesn't necessarily have to happen in real estate. It's just that's the easiest place, right? So again, if you can figure it out, where can you get cheap money and where can you get a high yield out of it? And then in the end, what you're going to be is in a position in which that is cash flow. And you don't really even have to work for it that much. So long as you understand that the amount that you were receiving in the yield has to go and pay for the loaning that you were borrowing that you had done to get the original, the original amount. Now, that part can get very confusing and very overwhelming for a lot of individuals, but it's simple to understand. It's not that difficult. The hard part, where do you get the money? How do you get cheap money? And this is the part where I think a lot of times it gets very confusing for individuals out there. And really the only place that you're going to find that you can get a lot of cheap money is going to be in the mortgage market. There's really no place else. Like, you can find lenders out there. I mean, I even found where I could use my precious metals to get a loan, and a very cheap loan. I mean, like, the interest rates were really low on it. Very questionable, especially when you're using silver. That's something really volatile like silver. You can find yourself in a very backwards position very quickly using a volatile asset like silver to try and secure a loan. But if you don't go for the max, like you just go for a small amount of money, but you put up a lot amount of collateral, like you put up a lot of silver for it, then you probably have less concern over it, but you just don't get as much money from that if you put up more collateral, right? But knowing that that's available, right? Like anywhere you can go to get cheap money and then deploy that money to a high yield. That's the game. That's it. Mortgages and real estate is the easiest way because the system is it's like baked into the cake. It's like baked into the system right there. All right. You guys enjoy that? We got 10 minutes into this live stream. I want to keep these things kind of short in the beginning so that the information is in the first 10, 15 minutes of it. All right, streaming UE in New Jersey. Wow, Standard Nurseries out in New Jersey. Right on. I took a supply line to find the angle stop, had failed, water everywhere. Haha, it was hilarious. All right. Off to store to grab another one. Mortgage deduction, 27-year depreciation cycle, or subsidized real estate is a no-brainer. It really is. I mean, it's just like it's already there. You don't have to try and invent it or get creative with it. It's already like millions of people, bunches of people are already doing it. They share their ideas on how they got it done, and it's like you don't have to reinvent the wheel, right? You don't have to get imaginative. You just have to follow what it is that other people have already shown how to do it. And that's not difficult. The difficult part is being like, how do I put it? Like excuse me, gee whiz, is being constant in view of the mortgage or of the real estate market so that you know when the good deals are showing up. Like if you just look at it one day, you're not going to know if it's a good deal. But if you're looking at it every day for 90 days, you're going to know when the good deals show up and when they're not there. So you're going to see what sells, what rents, all this other stuff. So once you're in that game, it's really not that difficult. It's just a matter of being in it and doing it pretty regularly and then, putting the work into it. But for me, like I'm the economist, right? I want to know what the underlying economic force is that's playing out. And that's essentially it. When I was thinking about it, it was just like, how simple can I explain this? And that's really it. That's the underlying economic force, is that if you can find cheap money and high yield, right? But it's difficult to find the cheap money. Like, how do you get cheap money? That seems weird. Like, cheap money just doesn't exist out there, but it really does. It exists in the places that people are willing to lend money to, right? So you think about it, where is it that people are willing to lend money? Well, mortgages seem to be fairly inexpensive as far as the interest rate that they are requiring for the loan. And then the yield on it, well, there's certain places out there that you can deploy that money to get the yield that's elevated to pay back the loan. So now that isn't that difficult, right? I mean, those two things is pretty simple to understand on how that's going to work. The difficult part is how do I get in? How do I get that loan? How do I come up with the down payment? How do I make the whole thing, all the logistics part of it? That part can be difficult, right? And that's where the creativity and imagination starts to come in to try and figure out how it is that you acquire the asset to get the loan, to get the good interest rates, to make the yield on the rental income, and all these things start getting very creative on how you actually make it work. But the underlying economic force is really simple to understand. How do I get my son to understand my home is not a money pit, but an investment? How do I get my son to understand that well, think about what is the meaning behind the ownership of the house to begin with. Are you living in it, or are you intending on using it to make money? Because if you're anticipating it being something that you make money, you really have two ways of doing that, right? You can increase the value of the house by upgrading it and, modifying some of the features of it or just whatever. You can force the appreciation of it by making a better place, or you can then turn it into a rental income that has cash flow to it. Those are the two things. If you're just going to live in it and just anticipate that it's going to go up in price over time, then that can be, that can be quite a questionable relative to how long you're there, where you're at, what kind of market you're in. So convincing your son that it's a good idea is really comes down to the meaning of the intentions behind the house itself. Are you just going to live there and hope that it goes up in value? Are you going to force the value into it? Are you going to get cash flow by renting it out? There's so many different things that are happening with that. How do you convince somebody that it's a good idea? Well, give it the right meaning, all right? Give it the right meaning behind it. All right. Okay. If the money's going in will never pay out. If the money going in will never pay out, it's a money pit. Yeah, and that's totally true. I mean, I think about it like most people, when they are buying a house, they are generally going to buy it to live in, right? So you're going to live in this house. And if that's the case, then you're going to put payments into it every single month and not really get anything out of it until the day you go to sell it, right? And so at that point, you're going to have to think, man, this is my place that I live. There's really no difference between my mortgage payment and a rent payment. Okay? There's really, like, in the grand scheme of things, there's really nothing that's any different until it comes time to move out or sell that property. Now, if you have rented, you have nothing. But if you have the asset that you have put money into, even though it may have been in the idea of like a money pit because all this interest and all this, stuff went into it, at the end of it, there's still an asset there. Even if it's a depreciated asset because you didn't take care of the house, you're still going to get something out of it, right? I mean, unless you just owe a bunch of money on the house and you let it devalue into a price that you couldn't even sell it for a profit, then now you got issues with it. But that's just the issue. Everything's either assets or liabilities. That's it, right? It's either an asset or it's a liability. Houses can be both, depending on what you're doing with it. That's it, right? Cars are a liability, but if you get a '97 Suburban, right, maintenance is pretty easy on it. Other than the gas and the insurance, there's really no cost to it, right? It can be an asset. It gets me to work on time every single day. I need it for the traveling. It makes the convenience so much better. But I don't have to put a lot of money into it. And so although it is an asset, it's an asset that costs me, but I think the benefit I get from it is more than the price that I put into it. If it was a brand new truck, completely opposite. It would be a money pit that it would cost me and it wouldn't be worth it. I made $48,000 profit, bought 500 shares of PLTR, $7 per share, sold for 96 per share. So my ex-wife from Jersey, she always said farm country. I grew up in the Midwest, farm country here versus there, perspective and stuff. Yeah, right. um, let's see, Captain, now stop provoking. All right. 92 people watching, 28 thumbs up. Thank you so much for hitting that thumbs up button. By hitting the thumbs up button, you'll get the YouTube algorithm to spread this video around for more people to join in. Everyone's a wise guy, though. I'm going to have this accent for a week. Ascent? I'm going to have this ascent? Is that what it says? I can't see it. Where are my glasses? Do I have my glasses out here? Oh, yeah, I do right there. Okay, perfect. All right. Stay out of my lane. Real estate is going to crash hard. Sell to me now before you lose everything. All right. Real estate seems like a slower way to go than entrepreneurship, capitalism, unless you are smart with the deal you make. Well, I would agree with that. I think real estate is a slow game to it, but I also think it's probably the most secure way of going about it in a sense, right? Like housing market collapses like we experienced in the great financial crisis, those things, I mean, I'm not going to say that they're impossible, but that's pretty extreme. And we had some extreme events leading up to it. And although I know a lot of people will say, dude, you don't even know how bad it's going to be when it happens, I do. I understand that the debt collapse that would take place would absolutely destroy the entire country. And if the mortgage market is failing, there's going to be a lot more than just the houses that you're going to have to be paying attention to as far as survival techniques, because that's just going to be a sign of the bigger problems that we have. But to understand that right now, if you were to invest in real estate, that's probably going to end up being one of the most stable places that you could ever get a return from, right? Generally, most people make their rent payments, and like not everybody. I know a lot of people who suffer the consequences of having rentals with, people who aren't paying. That happens, but for the general most part, I would assume that if you had a fairly decent amount of rentals with good tenants to them, then that's going to be a very stable existence with your investments. Not saying that you can't get that in other things, right? Especially that of being an entrepreneur, going out there and physically doing things to start businesses and getting those businesses off the ground and running, getting proper managers up in those businesses so that the cash flow is coming from them from a good experienced staff that you have working it, whether it's a store or restaurant or some kind of service business that you have created. that I would agree, like that is probably going to be the easiest, fastest way to grow a lot of money very quickly and really scale it up in a very profound way. Point being about that though is that you're going to have to be very creative on how it is that you access the new money in order to create that business, right? So if you screw up, you still got to pay the debt. That sucks. But if you could figure out a way to borrow money to buy a particular thing that's going to pay you over time, right? That's a pretty interesting way of going about it, and businesses can definitely be that way. Accessing the money isn't impossible. Putting the two together is something that I think creative people who are entrepreneurs can do in a very profound way, but the average everyday person is probably not going to be very good at that. Like, you have to be pretty savvy, like to know what business that you could start that's going to definitely pay, get the loan paid off, and then get that yield out of it. It's still going to require a lot of your presence and time. Now, I think about things a little differently in the sense that I don't like to admit it, but I'm kind of lazy, right? I don't want to put that much work into stuff. It seems like, putting my presence into something, I want to enjoy it. Like, I like doing sales at work. I like being here doing the thing. It's not always that great, and it takes my time every day, so that kind of sucks. But for the most part, the job itself is actually pretty easy and a lot of fun, man. I mean, doing sales is like, you're talking to people and making the deal happen or whatever. It's enjoyable, right? There's nothing wrong with it. Doing YouTube, a lot of fun. Doing bingo, a lot of fun. Like all the things that I do for money, I make sure that it's a lot of fun. Working on houses doesn't seem like fun. Okay? Maybe starting a business might be fun if it's the right business, but for the most part, it's a lot of time, effort, energy, commitment. You're working 18 hours a day to get this thing up off the ground and running, and boom, right? Once you eventually get it moving, okay, it might have been worth it at that time. I think that there's ways. Again, I'm a lazy person when it comes to investing and doing this kind of thing. I don't want to put that much effort into it, but I do want to be able to be helpful and useful and get a return off of it. So where is it that I can borrow money fairly cheap and then get a high yield off of it? That is it. How am I going to figure that part out? Is it going to happen in real estate? Probably, because that's where everybody's going to end up doing it. And it's the easiest way because it's already got a system that is designed to do that. If you can just figure out where to get the loan and what property to buy, right? It just, and it just kind of flows into that system. It just makes it work. But it doesn't mean that it isn't possible out there in different ways, right? And now just being in the understanding and the energy of cheap money flows into high yield. How do I do that, right? And that's it. You can even do something as simple as like, borrow, like use your car to borrow money from somebody else. Like if you have an extra car or whatever, to say, hey man, can I borrow $1,000? I'll use my car as collateral. I'm just trying to get creative. I'm just thinking of my own vehicle here or something. Just trying to get creative on how to acquire some money that has a low interest payment to it so that you can deploy that into a high yield. And there's plenty of places out there that you can get a high yield. Now think about it. The higher the yield, the bigger the risk. Uh-huh. So if you're putting into high yield, it's not safe. Not necessarily. It's just like a renter. You don't know if they're going to pay. Right? That's why it's higher yield that's coming in, is because you're taking that risk on. For the most part, if you're doing it right, the risk will probably be low or lower than if you just willy-nilly go at it, like, just let anybody move into your place and hope they pay rent. That's probably not going to work out very well. But if you're very cautious on how you're doing it, then you could probably deploy that money or deploy the idea of getting the yield into a safer place. You guys having fun with this video? Is this video any fun? Are you guys enjoying it? Hit the thumbs up button if you're enjoying this video. I have 2 rentals and have thought about more, but the time commitment is the catch. I have a 40-hour job, family, and live out of town on a small bit of land, no extra time. And now, again, this is where the creativity and imagination comes in, because most of the time you're going to find that owning a piece of property is going to require you to be there somehow. Like, you have issues with the property or whatever, you got to be close to it, but that's not necessity. That's not absolute. You can hire property managers to take care of the business for you, that sort of thing. Now, when that happens, it cuts into the yield. All right, just like anything else, you can borrow the money to buy the property, fix the property yourself, or you can hire somebody to fix it. That cuts into the yield. You can lower the yield by doing the work yourself, by managing the property yourself. By doing all this yourself, you make that yield bigger. Now, if the yield is already tight and you're doing all that work, it's probably not the greatest property for you, in the sense that it's probably frustrating and it's not working out very well. And I'm not trying to give you advice or anything like that. I'm not. What I guess I'm getting at is that the people who are doing the property management, all that other stuff, they're taking that little bit of yield that you would get from it, and that's probably not great for you, and it's okay for them. That's one. They're going on to the next, get another one, stack that up, and those little tiny yields that they get from all those different properties, even though they could probably get a bigger yield if they managed it themselves, they may not, because they may not have the time to do it. So deploying a property manager into that will then give you the ability to have your time and let them take care of the issues that come up from it. If they're a good property manager, everything will work out pretty well, right? Even though your yield will be a little bit smaller from it. My girlfriend and I talk about buying cheap places, fixing them up, and then renting them. The horror stories of being a landlord keep popping up. Well, yeah, and I agree with that. And like, this is one of the things that I get a lot from the position that I am in. I work at a lumber yard. I do retail sales for a living. I'm in a legacy city, right? Astoria is like hundreds of years old, right? There's buildings around here are old. They are in constant state of repair. The landlords, the property owners who come in that I deal with are there to fix up their properties. Think about that. They're there to fix them up. Why? Right? Either one, they're trying to get it ready for rent, or they're trying to deal with a past renter who has, destroyed their property or something of this nature. Now, understanding how that operates is like, holy crap, man, do I hear some horror stories, like daily. Do I get them? I go to these events like Zuber's event, and they really talk about all the home runs. And like, not always, like you hear the stories of how they had issues. Cody told this great story about how he bought this building, and like the next day the furnace caught fire and like burnt the building. He's like, man, this thing has been here for how long? And the day I buy it, it catches fire. Right? These are the stories that you hear constantly from everybody who has gotten into property. They get those. Some of it will sink the person. I was talking with the guy today who has a property up in Alaska. He's on his 5th person trying to owner finance it to get it sold, all that. Eviction process, trashing the house, having to redo it, get it all back up again, get another person in who's going to try and do and it's just like over and over again. And he's saying, man, I am so looking forward to getting out of this piece of property. And I'm thinking, dang, man, like I'm thinking about buying properties, and he's like looking forward to the day that he can get out. Now, one of the problems, it's way the hell up in Alaska. He lives here in Oregon, right? And that's the same issues that I'm thinking. It's just like, man, I don't want to be away from my property. I want to be very close to it so that I can keep an eye on it. Putting trust into a property manager, even if they're a great property manager, they could screw up. And at that point, man, now I got to figure this thing out. Talk about anxiety, right? Those are excuses. They're total excuses. Every one of them. Got to figure it out. Got to work around it. Got to figure out how it is that you can do it, even though those conditions are coming up. That's the point. Like once you get good at it, then you get really like, then things aren't those problems. You mitigate, you're dealing with those problems before they are a problem. All right. People don't pay their rent, but people do. For them, generally people pay their rent. All right. I'm gonna cruise down here to the bottom. There we go. All right. Well, you don't hear from the winners because they are greedy pig landlords. Ew. Or a jerk for being a winner and getting ahead. Now, this is really where I think the problem starts to come up, right? If I borrow money to buy a house, to then get a rental income from that, and the person doesn't pay the rent, who's liable for it now? Am I a greedy bastard because I am requiring you to pay the rent even though you don't have the money and you're suffering from a lost job and a divorced, a cheating husband, and you got all these issues and kids and stuff? And you're like, I'm just a single, woman trying to take care of these kids and stuff like that. And although it is very, very sad story, the bank doesn't care, right? I care, right? I care enough, right? But the bank doesn't care if I care, and doesn't care if I care about you. They don't care. They're gonna require it, and it doesn't really matter if you think that I'm a greedy person. If I can't pay it, everybody loses. This is business. That's what it is. It's business, and it sucks, right? In that sense, it is a horrible experience for everybody to go through. That's part of life. It's the business part of life, right? And it's just an unfortunate consequence of that, of being it. It's not greedy, right? It's not greedy. It's a matter of business. Would you go to work and then have your boss come to you and say, hey, I'm sorry, I can't pay you, right? But I need you to continue to work. Would you do it? Absolutely not. You wouldn't do it. So why would you expect anybody else to do it? It doesn't make any sense. And now it does suck because the rent is getting harder and harder and harder to pay. Understanding why that is occurring is very important because it doesn't have to do with the landlords making that happen. It's the underlying economic force that has created a situation in which that the landlords are doing it. It's not their fault, it's the economic environment that we are in. You can't say, hey man, you're charging too much. It's just like, this is the going rate. I borrowed at this. This is how much it cost. This is my payment. And that's the rent. That's it. Right? That's what's happening. It's not like an individual who's saying, man, I think I'm just going to charge more than I should. Yeah, that's what people seem to think, but it's not the case. Open communication with tenants is a huge, almost just as important as the actual purchase. I would assume that would be the case. I don't know. I'm not a landlord. But I would assume that would be it. Like if you have good communication with your tenant, then I would assume that things would probably work out much better, especially if you said, hey man, if you can't pay the rent, let me know right away and we'll figure out what we can do to make this happen, right? That's pretty, like, instead of just letting it be a surprise to the person, because you think about it, if you are a young business person who is trying to borrow money to get into rental incomes and you have somebody not paying the rent, the payment is still due. You gotta, like, people have to understand that if they are moving into a place where the landlord is borrowing the money to provide this rental property and you have moved into it, they are required to continue to make the payment even if you didn't pay the rent. And so who's the greedy one now? You're taking something. Who is the most at fault, people for living luxuries or the top 1% who control the hoard? Who is most at fault? Nobody's at fault. Like, that's the problem I think that you're taking on. You kind of have a tendency to be in, like, I'm not accusing you or anything, but like, I've seen your comments quite a bit, and you have a tendency to want to put a finger on a person and say they are the entity who is doing this to you. If you want to go down that road, you're on your own, man. I've gone down that road, and it will leave you into a life of depression, failure, misery, um, I don't know, whatever you want to call it, man. That's the path that you're on if that's the information that you are pursuing. Who did this to me? Who can I accuse? Who do I point the finger at? Why is the problem external? You'll never find the answer. As soon as you find the answer, you'll find another problem. As soon as you find the answer to that one, you find another problem. Because you're looking for an external problem. The problem isn't external. The problem is the meaning that you have given the information. Your problem's inside. That's where the problem is. Once you have recognized it, now you give it new meaning. It's not an external problem. It's the way that I have received the information and what it is that I am doing with it, because I see people out there right now who are absolutely killing it right here, right now, in this economy. And for somebody to say you can't do it, they're causing this problems, you're facing external issues that will prevent you from success, and yet I'm watching people be successful. I'm thinking, no, you got it wrong. You're giving the wrong meaning to the information that you have received, and you have put yourself on a path of destruction. I know, I did it myself. This is the reason why I'm saying it. All right. I wouldn't be worried about people not paying, but the place is getting trashed, and that happens so regularly. Like, I even met a guy one time who said that he just anticipates on remodeling it every time a tenant leaves. And now I don't know to what extent a remodel meant, but he just says, like, basically he's anticipating that it's just going to be trashed. Is like, I mean, I'm thinking, dang, man, you got to do better screenings or something of this nature. But I think, like, it's happened so many times now. Like, he's just, he tries to screen, does the best, and hope and wishes for the best, right? And just anticipates, hell, it's just probably going to end up being hammered anyway. Yeah. And I think, damn, that's a horrible way of going about it. But then again, it's also facing the realism of it, right? Like, hoping that it doesn't happen as opposed to anticipating that it does and dealing with it. And then it doesn't happen. It's like, hey, that's a better day, right? All right. Oh, I have problem, but want to learn. The Babylon system sucking the blood out of all of us. Huh? If you let it. Right? Wayne, talking to Adam. The longer you hang out here, the more you'll be understood. Now I got the animal song. Don't let me be misunderstood. Yeah. Not everybody can succeed in this system. Absolutely incorrect. Absolutely incorrect. Everybody can succeed in this. Not everybody will. That's the difference. All right? Everybody can. Not everybody will. Huge difference inside of that. Good afternoon. Need durable stuff like hotels. All right. Josh with the good afternoon. A lot more money and huge wealth made buying, holding quality stocks than swing trading. It's the system, not any one. I would rather push button swing trading than owning so much easier. Yeah, I mean, well, that's, and I don't think there's anything wrong with that. Like, if you could figure out your way, if you figure out your method of being able to get into the flow, all right, whatever that is, if it's done in stocks, if it's done in real estate, if it's done with business, entrepreneurship, if it's done whatever, like, figure that part out. That part, being industrious, I think that's like step one, right? You got to be industrious. Step two is securing the interest. Securing an interest beyond that of your occupation. However you do it. Like, however, you can bonds, more businesses, real estate, like all kinds of different things. But ultimately, at the end of it, it's to be a property owner. So being industrious, whether it's done like, I mean, I don't know why people get upset. You shouldn't do it in rentals. You should do it in this. You should do it in that, all these other things. I'm thinking, I don't have a problem with anybody getting into flow in any way they can. Show up at a job. You're in the flow. Take the flow and put it towards something that is going to have a return, whatever that is. The easiest way to do this and the fastest way to do it is to borrow money. Borrow money and put it towards something that is going to be putting you in the flow. Right? How do you borrow money cheaply? Well, where is it that cheap money flows? Mortgages. Wow. Okay. Well, how do you get cheap money in mortgages and then get a return off of it? Rental incomes. Where do you get a good, decent return on rental? Good luck. That's the game. Find cheap money, put it towards something that is going to have a high yield. And that's it. That's how these people do it. It doesn't need to be complicated. How you do individually, like each one of the persons, where they borrow the money and what it is that they're putting it towards, whether they're borrowing it in a mortgage and then putting it towards rental, right? If that's the case, everybody's going to have a unique style in how they got that done, right? There's very similarities to it, but for the the person who is like taking on strategy, it's going to look very different. I mean, some people might get into a house first, house hacking, then get a loan on the house later, right? Get it do an owner financing thing or something of that nature. So many different ways of going about it. Anyone have any thoughts on RV parks? The definition of success I like best and use is the progressive realization of a worthwhile goal. Yeah. All right. Estimate to me when this market choppiness ends. Then, sure, you can gamble, and I do, and it's fun, but not the most profitable. Huh. Yeah, I don't think of it as gambling. I don't see gambling and investing as the same thing. Like I've heard that a lot, gambling in the stock market. And I'm like, gambling, you're taking a shot, like a shot in the dark. Who does that? I mean, I guess people do all the time. I even heard of somebody saying like they just go in and buy 3 houses, and I'm like, who you just go buy 3 houses? I guess there's people out there who do, but I don't. Like that's just, you know. So, to me, like I think about that is just like everybody's going to end up being like so different in how it is that they handle their situation and what it is that they are going to do. But to recognize what the economic force is, that's it. Like people say, man, what's the magic secret to it? It's not a magic secret. It's not, right? Mortgages have cheap interest rates. When people are borrowing money, you think about it. If you borrow money on a credit card, is that cheap? No, it's hell expensive. You go out there and say, hey man, I just want a personal loan. You got nothing to show for it. You just want money. Yeah, it's going to be expensive. But it was just like, hey man, I have this underlying asset here that I can use as collateral. Oh, guess what? Interest rates come down. Okay, so now we think about it. It was just like, how do we get cheap money? That's it. How do you get cheap money? Now, if you are able to acquire cheap money, what do you do with that cheap money in order to get a higher return than the interest that you're paying? And then you also have to understand that even though you're getting a higher return, so I'm borrowing a 6, but I got this return at 8, well, you're getting a 2% yield. If you have inflation running at 2.3%, now you got a negative 0.3% return, real interest rate. Knowing how this works, right? Understanding how that operates is going to give you so much better understanding of how it is that you position yourself, and to understand how it is that elevated inflation is actually making the economy less restricted because it's lowering the real interest rates. Most people don't see that. They don't know. They don't understand. But once you get it, once you internalize it and see it, you're like, oh man, if I could borrow money at this high, you see what I'm saying? In a high inflationary environment, then the real interest rate is much less. That's pretty good, and that's a pretty good return if you can get the yield out of it, right? Get that higher yield. All right. What is the topic today? Interest rates, All right, it's not that hard. Most people cannot get loan other than for a house. It's not that hard. Right. But well, see, that's just the point. Like, you're not going to be able to do it as quickly in other things. Like, how do you, like, if I, okay, here's again a good example of it. If I'm going out to a bank and I'm saying, hey, I want to borrow money to buy a house, right? The house itself is the collateral, right? You got to come up with some down payment. So if you can come up with a down payment, the house itself becomes the collateral, and then you can get the loan for it. Now, if I use like my precious metals and did this like precious metals equity loan, right? And I use my silver as collateral. I put my silver out there. I get the money for that, and now I can use that money to deploy to a yield, right? It doesn't really matter. I can put it into rentals. I can do whatever I want with it if I have this money. Now, the problem with it is that if I go to tap into more money, I need more precious metal. So I can't tap into any more money because there's no more metal to use as collateral. And this is why it works so well inside of the mortgage markets, is because you just go and find the asset that's out there, and then you use the asset itself as the collateral to get the loan. You don't really have to have anything. You just have to find the right deal, find the right purchase price, find the right rental, find the right market so that you can get the return on the rental of it, and they literally just give it to you. And it's like, here you go. You don't have to have anything other than maybe a down payment or something, right? Be creative with that. So this is different from where it is that you can get cheap money anywhere else. Because without an asset, without a collateral or something, there's no way you're going to get the cheap money in order to get the return, the yield. You got to have cheap money. You got to be close to cheap money. Got to be close to it. How do you get close to it? Well, again, got to have an asset out there somewhere that is going to be backing that loan. Precious metals, real estate, something else. You already have it, or whatever. Like, I was even thinking, like, I could, there's money that could be tapped into a 401k. Now, granted, probably the interest that you're going to end up paying on your 401k from tapping into that is probably not going to be very easy to then go out there and get a return on it, because the interest on it is probably going to be a little too high. But it's a place, right? The car is a place. You can use these things to acquire money somehow, somewhere, from someone. And if you can figure out how you can do it at a low interest, then you figure out where it is that the high yield is. That's the only underlying economic force playing out. Okay. And then the creative parts of it, right? Does the asset go up? Can you force the appreciation? All this other stuff. My phone's about ready to die. I think this was a good, interesting, video myself. I think it's a very good topic to understand and to then recognize the underlying economic force that is playing out. This is the important part, right? Most people don't see it. They don't understand. They think it's like some kind of creative game that is being played out there, which it kind of is. But to really understand it from the economist, from the economics point of view, so that you can position yourself, is to just understand that it's a borrowing at low rates to get a high yield, and then get the creativity within that, right? Mortgages are just baked into it. They're already cheap, and the yield, if you can find the rental, is already high. You don't really have to try and figure it out. What you have to figure out part of is where the market is, like what market is going to be conducive to that. Does that all make sense? I hope so. Uneducated economist, you guys let me know.